13,000 people are about to wake up rich. Not lottery rich, generational rich. The kind of rich where your grandkids are still living off a decision you made years ago by taking a job at a rocket company and getting paid partly in something most people would have thrown in a drawer and forgotten about. In a few days, that drawer turns into a stock ticker, and the single biggest IPO in the history of the planet goes live. 13,000 people inside that building are set for life. The only question left is whether anybody outside the building gets a seat too. Whether someone with a normal income and a normal brokerage app can grab a piece of this, or whether you just watch it happen on the news like every time before. Because this time, something is genuinely, structurally different, and that difference is the entire reason you're here.
My name is Jude. I spend an unhealthy amount of time pulling apart the question of why some people end up on the inside of these wealth events while the rest of us find out about them on the news afterward. If you've ever watched a company you loved go public and felt that quiet gut punch of, man, I should have been part of that, stick around and subscribe, because today we're breaking down exactly how thousands of people are about to get rich off the biggest IPO in the history of the world. And then, root by root, we're answering the only question that matters to you. Could you? There are exactly 4 ways a regular person can get a piece of this. 3 of them you've probably half heard of. The 4th one, the one that's actually wide open with $100 and a phone, almost nobody is talking about. I'm deliberately saving it for last. Stick with me to get there.
Let me tell you what's actually happening, because this is not a rumor anymore. For about 15 years, this rocket company going public was the financial world's version of "this is the year the underdogs win it all." People said it constantly. Nobody believed it. The founder spent more than a decade swearing he'd keep the company private. The whole point was a 30-year mission to Mars, and you can't run a 30-year mission while Wall Street screams at you every 90 days about quarterly earnings. That held. And then it didn't. As of now, the company has filed its paperwork with the SEC, made its prospectus public, and locked in a plan to list on the NASDAQ. Price set at $135 a share. Trading debut just days away. Valuation? Roughly $1.75 trillion. Trillion! With a T! Let me say that differently. $1.75 trillion is more than the entire GDP of countries like Australia or Spain. A single company that builds rockets is worth more than most nations on Earth. And here's the part that should make you sit up. This offering is reserving around 30% for regular retail investors. Not hedge funds, not pension giants. Regular people with regular brokerage accounts. Quick disclaimer before we go further. I'm not your financial advisor. This is not financial advice. These are the mechanics, the math, and the honest trade-offs. What you do with them is entirely your call.
Before we keep going, if this is the kind of breakdown that's useful to you, hit subscribe. I cover the real mechanics and math behind the financial events most people only hear about after they've already happened. Let's keep going, because the size of this thing is genuinely hard to comprehend.
Let me put the size of this in perspective, because biggest IPO in history gets thrown around a lot, and most of the time it's marketing. This time, it's just true. This offering is looking to raise somewhere in the neighborhood of $75 billion. The previous record holder was a massive state oil company IPO back in 2019, and that's not some scrappy startup. That's the literal oil company of an entire kingdom. They raised about $29.4 billion. So this isn't edging past the old record. It's more than doubling it. It's taking the biggest IPO that has ever existed and lapping it. Now, let's talk about who's actually getting rich, because thousands of people is not a figure of speech here. It's close to a literal headcount. Start with the employees. This company has somewhere around 13,000 to 18,000 employees holding equity, stock options, restricted shares, the whole package. And this company has done something for years that most private companies never bother with. Roughly twice a year, it runs what's called a tender offer. In plain English, the company organizes a big buyback where employees and early investors get to sell a chunk of their shares, usually 10 to 25% of what they've got vested, at a set price. It's a pressure release valve. It let people who'd been there for years actually touch some of that paper wealth without the company ever going public. And every one of those tender offers is what set the valuation milestones we just walked through. The company sells you on a dream. You take options instead of a fatter salary. The options sit in a drawer. The valuation climbs. And twice a year, you get to cash a little out.
Let me put a face on that, because thousands of people getting rich stays abstract until it's one actual person. Picture a senior engineer who showed up early, took the stock options instead of a bigger paycheck, and just held on. That person's half-forgotten drawer of equity is now worth around $4 million. That's not a fantasy for drama. That's the median outcome for a senior person who showed up early, took the equity, and just held on. Let me run the actual math. Say you joined as a mid-level engineer back in 2013 and got granted options on roughly 10,000 shares. Adjusted for stock splits, the price back then was a tiny fraction of where it is now. Through every tender offer, you sold a little, paid off student loans in 2017, down payment on a house in 2019, family trip in 2022, and you still had the bulk of it sitting there. The shares you held through to this IPO at $135 a piece are the difference between a comfortable career and never having to work again if you don't want to. That's not a lottery ticket. That's 16 years of showing up paid out all at once. And there are thousands of versions of that person right now, quietly refreshing their brokerage app.
There's reporting that the company's president and chief operating officer, employee number 11, by the way, who joined back in 2002, is sitting on a stake worth over $1 billion. The chief financial officer, same story, north of $1 billion. One of the early board members is reportedly looking at something in the neighborhood of $70 billion. 70! That is not a typo, and I did not stutter. That executive gave a rare interview earlier this year. Asked about the IPO, she basically said she's not really supposed to talk about it, but that she's genuinely looking forward to it. A whole new set of tools for running the company. When someone who's been there over 20 years and is about to become a billionaire sounds excited rather than nervous, that tells you something about how the inside feels about this.
But the employees are only half the story. The people who really hit the jackpot are the early investors who wrote checks when this company looked like it might die, and it almost did. In 2008, this rocket company had failed its first 3 launches in a row. The founder was nearly broke, pouring the last of his money into the company. The 4th launch was do or die. Right around that desperate moment, a venture capital firm wrote a $20 million check. $20 million into a company that had failed 3 times and was running on fumes. Here's what that $20 million turned into. According to reporting, that firm's gain since the 2008 bet is more than $19.5 billion. Their entire firm, every other investment they've ever made combined, manages around $17 billion. Their winnings on this one company are worth more than their entire fund. The appreciation works out to something like, and I genuinely had to check this twice because it reads like a typo, 62,000%. Let that sit for a second. 62,000%. Then there's a major tech giant. Back in 2015, they invested $900 million into this rocket company, when the whole thing was valued at around $12 billion. A regulatory filing in 2026 revealed that stake had grown to a little over 6% of the company. At a $2 trillion valuation, that 6% is worth roughly $100 billion. So they put in $900 million and turned it into something like $100 billion. That's a 64 times return, and it sits quietly on their balance sheet as one of the most profitable side bets any tech company has ever made. A major asset manager has a big chunk too. A famous venture firm is in there. Another top VC led around. The list of people about to look like geniuses is long, and it is real. To understand how the rest of us get anywhere near this room, you first need to understand how this whole IPO machine actually works, because it's weirder and more rigged in the insider's favor than you'd think. A private company decides to sell shares to the public. It files a giant document with the SEC called an S-1. Basically, the company taking its shirt off in public, showing everyone its finances, its risks, its secrets. Then it hires a syndicate of investment banks, in this case more than 20 of them. Those banks go on a roadshow, flying around, pitching big institutional investors, figuring out demand and price. Then comes the part that should make you a little awake. When the IPO prices, the banks decide who gets shares at that initial price. Historically, about 90% of those shares go to big institutions, hedge funds, pension funds, mutual fund giants, 90% straight to the club. The 10% left over is the table scraps the rest of us are supposed to fight over and feel grateful for.
On the first day of trading, the stock very often pops, opens higher than the price insiders paid. There's solid data on this. A finance professor named Jay Ritter has tracked thousands of IPOs going back to 1980. Across more than 8,000 of them, the average first-day return is about 17.9%. So institutions who got allocated shares at the offering price are frequently up double digits before lunch on day one, just for being in the club. Meanwhile, founders and employees can't sell anything yet because of something called a lockup. A lockup is a period, usually 90 to 180 days out the IPO, where insiders are legally barred from dumping shares onto the market. The point is to keep the people who own the most stock from flooding the market the second it opens and tanking the price. This IPO's lockup is structured in a rolling way. After the first earnings report, insiders can sell a slice, then a bigger slice, with the whole thing fully unlocking around 180 days out, roughly December of this year. The founder himself has to hold the entire time. Keep that lockup date in your back pocket. It's going to matter when we get to whether you should buy.
Does this machine actually create thousands of millionaires, or is that just a nice story? Let's check the receipts, because history here is almost suspiciously consistent. A search engine giant went public in 2004 at $85 a share, closing day one up 18%. That IPO reportedly turned most of its roughly 2,500 employees into millionaires, not just engineers and executives. The in-house massage therapist, who'd taken equity instead of a bigger paycheck, became a multi-millionaire. So did the company's chef. Estimates suggest around 1,000 people connected to that company were holding more than $5 million in stock each within a few years. An e-commerce giant went public in 1997 at $18 a share. $10,000 invested at that IPO and never touched. No panic selling during the dot-com crash. Would have grown to something like $16 million a couple decades later. One economist estimated that company created on the order of $1.6 trillion in net wealth for shareholders by 2020. From a company Wall Street openly...
So why is everyone so convinced this is the real deal and not just hype with a rocket strapped to it? Because the bull case here is genuinely exciting, and I want to give it to you straight. Here's what makes this company special. And it's not actually the rockets. I mean, the rockets are insane. In 2025, this company accounted for around half of every orbital launch on the entire planet and launched something like 85% of all satellites that went up. They're not the market leader in space launch. They basically are the market, with everyone else fighting over scraps. But rockets as a business are lumpy, expensive, and hard. The thing that turned this from a cool engineering project into a $1.75 trillion company is the satellite internet constellation. As of early 2026, it has over 10 million subscribers across more than 155 countries, a number that doubled in a single year. It pulled in around $11.4 billion in revenue in 2025, up roughly 50%. And it's profitable, with an adjusted EBITDA margin north of 60%. 60%! Do you understand how rare that is? That's software company economics. The hard part, designing satellites, building rockets, getting things into orbit, is mostly a sunk cost. Once the network is up there, every new customer...
And here's the part of the story that I think is genuinely underappreciated. The thing that turns a good business into a fortress. To compete with this satellite internet network, you don't just need a better satellite, you need to put thousands of satellites into orbit. And launching thousands of satellites affordably requires reusable rockets that land themselves and fly again. A capability this company spent over a decade perfecting, essentially alone. Every competitor trying to build a rival constellation has to either pay this company to launch their satellites, funding their biggest rival, or attempt to build their own reusable rocket program from scratch, which has taken over a decade and tens of billions of dollars to get right even once. That's the moat. It's not a patent, it's not a brand, it's a physical, decade-long head start in the single hardest part of the entire chain.
So here are the 4 ways in, as promised. Way 1, become an employee. Obviously the slowest and least accessible path, but it's the one that minted the $4 million drawer we talked about earlier. Way 2, pre-IPO share marketplaces. Several platforms let accredited or sometimes non-accredited investors buy shares of private companies before they go public, but minimums are often high and supply is limited and restricted. Way 3, IPO allocation through your broker. With this offering reserving roughly 30% for retail, a number of major retail brokerages have struck deals to offer their customers a shot at shares at the IPO price itself, not the pop price. This is the one most people have half heard of, but assume they can't access. Worth checking your specific broker's platform in the days before listing. And way 4, the one almost nobody is talking about, the one that's wide open with $100 in a phone, simply buying shares on the open market the moment trading begins. No employee status required, no high minimums, no accreditation, no lockup for you. You can buy the literal first minute it's tradable. The same minute the institutions who got allocated shares at 135 are already sitting on a 17.9% average pop. You won't get the insider price, but you also don't need $20 million, employee number 11, or a decade of waiting. You need an account that's already open, and you need to know the date.
Now the cold math, because the bull case is real, but so is the other side, and I'd be doing you a disservice not to walk through it. A $1.75 trillion valuation already prices in an enormous amount of future growth. That's not a company priced for might do well someday. That's a company priced as if the bull case is already substantially true. There's less room for things to go better than expected than there is room for things to go worse. The lockup expiry, around 180 days out, has historically been a moment when previously public companies see real price pressure as insiders who've been waiting years finally get to sell. That's not a guarantee here, but it's a documented pattern across the IPOs we just covered. There's also founder concentration risk. An enormous amount of this company's story, strategy, and valuation is tied to one person. And here's the one that matters most for someone using Way 4, buying on the open market. The day one pop means retail buyers often buy at the highest price the stock trades at for a while. Remember, even the legendary winners, the e-commerce giant, the car company, had years of brutal drawdowns along the way. The 12-year and 20-year numbers are real. So were the 80% drops along the way that most people couldn't sit through.
So here's what to actually do with all of this, calmly, not from hype. 1, check whether your specific broker is offering any kind of IPO price retail allocation for this offering, and understand the actual mechanics. Often it's a lottery-style application, not a guarantee, even if you qualify. 2, if you're buying on the open market once it's trading, decide your position size before the hype hits, based on an amount you could genuinely lose entirely without it changing your life. The day one pop means you may be buying near a short-term high. 3, mark the lockup expiry date, roughly 180 days out, on your calendar. Historically, that's been a volatile window across the IPOs we covered today. 4, zoom out. Even in the best case histories we walked through, the e-commerce giant, the car company, this is one position in someone's broader portfolio, not the entire plan. The thousands of people getting rich from this IPO mostly got rich from over a decade of holding, not from the first afternoon of trading.
13,000 people are about to wake up rich because of decisions made over the last 16 to 20 years. Equity instead of salary, a $20 million bet when the company was failing, a $900 million side bet that became $100 billion. Most of those doors are closed to you and me. They always were. But the fourth door, the one almost nobody talks about, is just open. It's open the same way it was open for anyone who bought $10,000 of the e-commerce giant in 1997 or the electric car company in 2010 and then did absolutely nothing for a decade. You won't get employee number 11's price. You won't get the venture capital firm's 62,000% return, but you also don't need any of that to participate. You need an account that's already set up, a number you've decided in advance and can live with losing, and the patience that every single one of those historic winners actually required, which notably is the one thing that costs nothing at all. If this gave you a clearer picture of how these wealth events actually work and how the door is more open than most people assume, hit that like button and subscribe. Every week I break down the mechanics behind the financial events most people only hear about after they've already happened. And if you want to understand the bigger forces moving trillions of dollars around the economy right now, the kind of shift that creates these moments in the first place, the video on the $124 trillion wealth transfer is right there. That's the macro picture this IPO is just one piece of. I'll see you in it. One more time. Not financial advice, just the mechanics, the math, and the honest trade-offs.